Hi there. So, I wanted to talk a little bit about one of the six major wealth destroyers that I've mentioned several times. And the one that I want to focus on today is the one where we talk about knowledge, mindset, belief, right? And it is really important that we do get informed and we get good, solid information when we want to make a financial decision, whether it's for personal finance or any other type of money decision. And so obviously we are here January 2021. There are so many different platforms from which we can, gather information, whether it's from the TV, podcasts, and social media. And so I'm just as guilty, right? Some of you may have found me because you saw me on a LinkedIn post or an Instagram post, and that is social media. So I'm not saying, or I'm not about to say that or insinuate that everything that you see on social media or everything you see online is wrong or inaccurate. I'm simply just saying to use some level of discernment. Okay. So, apply due diligence everywhere, especially when it comes to the advice that you seek for your finances. And so, what I wanted to cover today or talk about today was this article that I saw. Someone, I think it was Popcorn Finance. He had mentioned this in an Instagram post, this article, and I thought, wow, this would be great to walk through for the podcast because there's just so many people who believe everything that they read online, unfortunately. And so this article talks about it's called Terrible Financial Advice is Going Viral on TikTok. TikTok is full of dubious personal finance myths. Here are 10 of them and why you should be wary. So the authors are Rebecca Jennings and Emily Stewart. And I just thought they did a great job of capturing just a few of what you can find out there. Now, I am not on TikTok, so I can barely keep up with LinkedIn and Instagram as it is. So I barely go back onto Facebook, really just to visit a few groups. But I really wanted to walk through this article to cover some of these myths. Okay, so FinTalk, hashtag FinTalk or hashtag Stock Talk. That's what you might be seeing if you're on the TikTok platform. Okay. So I'm just saying simply, I'm not saying to ignore it. Beware, there might be other licensed financial professionals like myself who are on there. But again, just use your due diligence. Let's use some research and some common sense to see if what we're hearing or reading or seeing makes sense. Just because someone is attractive or they have a million followers or they make a video really fun, it does not mean that what they're sharing is accurate. So my goal is always to get you the truth, the whole truth, right, about your money. So here's the first myth. So they say the claim is if you start an S corp, you don't have to pay taxes. So I am not a CPA. I am not licensed to give tax advice. However, just because you establish a company as an S corp does not automatically mean that you don't pay taxes. I'm not sure where this comes from, but I wanted to play this TikTok video so that you could see this claim.
What's a piece of information that you learned that feels illegal to know?
That if you start an S corporation and you own 100% of your S corporation, that you can buy everything that you own under that S corporation, and then you don't pay taxes on anything that you purchase because it's considered a corporate expense. And you can take one corporate vacation a year, and depending on how much money your corporation makes, that price actually fluctuates up. And you can actually hire your children to work for you for $12,000 a year tax-free. So then you're actually showing an expense, but you're gifting it back to your own family household. And then you pay yourself a salary, which means you pay less self-employment taxes. And then basically at the end of every month, you're left with $0 to pay real taxes on. It feels really shitty to do it, but it's kind of how you avoid paying taxes. So I don't know.
Okay, so that is an example that was shared on in this article, right? You can see that it has 1.5 million likes. I believe that's what that means. Or there's 20,000 comments. I don't know if that just means this person has 1.5 million followers. I'm not sure because I'm not on TikTok. But obviously, this video has been viewed many times. Okay. So it's just very concerning that someone is sharing that. I'm not saying that everything she shared is wrong, but certainly if I were you and you're considering, starting a business, whether it's for investing or because you actually are starting an actual, a traditional business, please go see an attorney and ask them and speak with a CPA and ask them, what is the best structure for your business? Should it be an S Corp or not? Even if you have an LLC, should you file taxes on S Corp or C Corp or sole proprietor? I mean, ask a licensed professional to confirm what you're hearing, okay? Because not everything that she just said is true. Okay, let's move on. So number 2, okay, the claim. The Federal Reserve has secret $1 million bank accounts for every American citizen. I have never heard this. I don't know what kind of platforms or what channels this type of information floats around on, but this is absolutely not true. And it looks like in 2017, the New York Times actually tried to, dive in and explain, how and why this is not true. It says that they reported over 107,000 payments totaling more than $100 million had to be reversed just in a 3-month period because people were using like a Federal Reserve bank routing number. I don't know, but guys, there are no secret $1 million bank accounts for every American citizen. Again, I don't know for sure, but I feel very confident that that does not exist. Okay, so don't believe that. Number 3, you can become a millionaire if you open an MPI account. Okay, now I am not going to speak badly on any other financial professional who's out there because I don't know everything. It is very certain that, it's very possible that there are people out there who know more. But this video seems to be with Curtis Ray. Considers himself a personal finance entrepreneur. He's got 1.25 million followers or 1.2 million followers on TikTok. Let me show you this video and then I'll comment after.
Hey,
What's up?
Maria Franco commented asking, I need more information. My husband makes 80 and I make 56.
Oh, that's freaking awesome. Let's go see what the math says. Hey there, Maria. Here's what I recommend. What are you willing to sacrifice? As an example, let's take your husband's income, and that becomes your living expense. Then we're going to take all of your income, $56,000, and we're going to get in a secure compound interest account. What's the result? You can be a millionaire, but more importantly, a tax-free retirement income of up to $110,000 a year every single year for the rest of your life. And guess how long it takes? As little as 11 years. I'm Curtis Ray. Let's get your money compounding.
Okay. Now he is using or referring to a product called MPI. Okay. Basically, all this is an Index Universal Life Insurance Policy, IUL. And if you've heard me speak before, I'm not a big fan of IULs. The premise, I think what he's trying to show is essentially number 1, if that couple is able to live and if they can afford to live off of one person's income, they can really then use their other person's income to be more strategic. In his strategy, what he's proposing is they would, plow that into an IUL. He's, of course, making assumptions about how the IUL will grow. If you're not familiar with an IUL, it's essentially a life insurance policy that has sort of an investment component to it. There's a portion of your money that will get, it will follow an index that follows the stock market. So you can potentially, earn or gain, more earnings than you would in a whole life insurance policy. Okay. And that's a whole other episode going into that. But like I said, I'm not a big fan of IULs simply for 2 key reasons. Number 1, I feel like insurance should be just that. It should be insurance, not an investment. It should be safe, secure, risk-free. It can certainly act as more of a savings vehicle right? It's where you can really safely put money away. It's, kind of out of the purview of the IRS. You have a lot of flexibility in what you can do. You can, pull money out in during retirement if that's what you want to use it for, to supplement money that you have in other retirement accounts. But you can use it, while you're alive for investing and doing other things. And again, that's a whole other episode. But what I also don't like about IULs are the fees. Okay, so there's definitely fees that are part of IULs that are not part of whole life insurance or other life insurance products. And then the third main thing is really just the fact that if you don't keep up your IUL policy, a lot of times people will, they won't have the death benefit that they're looking for, particularly in their later years, because they didn't necessarily keep up the flexible payments as it's always marketed, or, because the costs increased more than their cash value grew. They don't have as much there as they thought they would. So there's a lot of different, factors that go into IUL that I'm not a big fan of. I know there's a lot of people who are huge fans of IULs. But in any case, this is someone who sort of come up with his own name and kind of marketing pitch to get people to, think it's sort of lickety split easy like that. It isn't necessarily easy like that. But you can do similar to what he's doing with, whole life insurance as well. But what I would say is I would need to talk to this couple. I need to understand their situation. I don't know if this is something that would work for them. Yes, this is an option out there, but you can't just assume that, every marketing ploy will work for you. So just be mindful of that. Okay. All right, let's move on. Number 4, the claim. You can pay less on hotels if you buy their points. Now, I'm not a big point person. I do know people who use, they really live their life through points. And actually, maybe I'll invite my friend on to a future podcast. But yes, they have been all over the world with their points and all that. But I guess in general, I would say that I don't think that hotels points are going to be, cheaper than cash. I think there are different bonus structures. There's different ways to earn points, but I'd be mindful of just saying just buy the points and then just use that to pay for your hotel purchase. I don't think that that's fully true. Okay. Number 5, the claim, just buy Tesla calls. Okay. So calls and puts it's basically having to do with options trading. Now, this is something that is very risky, right? So when we talk about if you are even in the position to be considering these types of investment moves, I always ask, number 1, do you have your emergency savings in place? Do you have insurances in place, whether that's life insurance, asset protection, like your home, car insurance, umbrella policies? Do you have those basic protections in place? And then do you have, some more, I don't want to say less risky because all investments have some level of risk, but, do you have other forms of investments in place? And if you can check all of those boxes, then I'd say, yes, let's start thinking about or learning more about something like options trading. But this is something that you really would want to do with money that you can afford to lose. This is like your play money. This isn't just okay, I'm in debt up to my eyeballs and I need some money quickly. Let me try options trading. That's not what options trading is for. Okay. So in this particular claim, they're saying just buy Tesla calls. I'm just going to say in general, for most people, this is not a good idea. Calls and puts options trading is really not for most people. Okay. Be cautious. Let's see. Number 6, just short the stock market. So again, it's very similar, right? But basically you are guessing and hoping, wishing and praying that a stock or, something for you're hoping for a particular outcome, but no one can predict what's going to happen with the market with any particular stock at any particular time. So again, I just say, if you don't have those 3 key things, your key emergency savings, your insurances in place, and, some other type of investing in place first, this is not something that you should be thinking about. Again, leave this to the experts if you do it at all. Okay. Number 7, the claim, just copy the investments of rich people. So, you know, I can't say that this is a great strategy because again, this is about timing, it's about costs, right? If quote unquote rich people have a great portfolio or something like that and you see it, well, first of all, what price did they pay to get in, right? They may have, got into certain stocks or whatever it is earlier on at a lower cost, and maybe right now isn't the best time for those particular stocks for you to jump in. I don't know. You're making a whole lot of assumptions just by saying, oh, Bob over there is rich. This is what his portfolio looks like. I'm going to do the same thing. Again, not always the best way to decide how to invest. Okay? Ooh, so scary. Number 8, pay as little on your down payment and mortgage as possible. Now, and again, I guess this is the same Curtis Ray who talked about the IULs. Now, I actually don't think this is a bad idea. So let's see, they said here what this really is. There's no one right way to approach your mortgage, and you should talk to a professional, many of whom will tell you that this is not a bad idea. But also, this guy is saying not to pay your mortgage because he wants you to invest in a product he's hawking. So again, be mindful. So yes, I would say if you are trying to wait till you can save 20% to put down on a home as opposed to being able to put 4% down with a conventional mortgage, that's why I say the sooner you can get into a home, do so. So if you do it with 4% down and you have some PMI, in my opinion, of course you can do the math and this probably can be specific to each person's situation, but for most people it makes sense because the sooner you can get in and start to have home ownership, especially with how low mortgage rates are right now. And in so many areas of the country, it is cheaper to buy than it is to rent. So if you're able to get in at 4% instead of waiting till you have 20%, you should be, strongly considering to do that. And you don't have to only look at a single family, right? Or if you do, think about, inviting some friends to move in with you and help, and they can pay rent and that can cover those costs. There's so many different options. Maybe you can find a multifamily, like a 1 to 4 unit, and you live in one unit and rent out the other 3 units. And there are programs out there. You can get a 4% loan to do something like that. There's so many different options, but right now is an excellent time to be looking into home ownership because of these interest rates. So I actually do agree that you should pay as little down as possible as you can to get in on a property. Now, if you are feeling overwhelmed or concerned about the PMI, because you will have PMI up until you have 20% equity, well, then you can start putting some more down until you reach that 20% level. But don't wait to get into a property just because you don't have 20%. Okay? That's just my general, education. As I said, it can be specific to each person. It could depend on, different things, but a mortgage is not, as bad as some people think. You have to remember that, and maybe this rolls right into this one, number 9, the claim actually you should pay more on your mortgage. Okay. So it does kind of roll into what I was about to say, is that for some people, it might make sense. Okay. But when you think about it, when you get into your, 50s, 60s, 70s, you really don't have many write-offs at that point, right? If you are in your 20s or 30s and 40s and you're trying to hurry up and pay off your mortgage, first of all, you're putting a whole lot of money into a brick and mortar, like literally a brick, asset, which your home is definitely a mortgage is definitely a liability. Your home is an asset, but those funds could be used to grow in other ways. Remember that, one of the other wealth destroyers that we talk about is opportunity cost. And so the opportunity cost of you putting that extra money into your home, as opposed to putting it elsewhere where it can be leveraged or it can be invested, is huge because you can't get back time. You can't get back time. And remember, once you've paid off that mortgage, you can no longer write off the interest, right? From your taxes. So there's a lot of things to think about. I know that some people feel like the weight of the world when they have a huge mortgage. And so that is definitely something to think about. I mean, it doesn't make sense for you to be stressed and losing sleep because you have a mortgage. If it's going to make you feel better to pay it off faster, then you should do so. But just know from a financial standpoint, it's not always necessarily the best strategy. So that's something that we could certainly talk about and, run numbers and show you so that you can kind of see, where it makes sense. It's kind of the discussion I get into sometimes with people is, does it make sense to have a 15-year mortgage versus a 30-year mortgage? Okay. Anyway, again, that's a whole separate episode. Okay, so number 10, the claim. Invest in compound interest as early as possible. Um, former pro skater turned investment firm co-founder Mikey Taylor says that 18-year-olds should invest $300 each month in the stock market for 8 years, and by the time they retire, it will be worth $1.8 million. They're saying that this is a pretty solid long-term investment strategy, but things you should consider. The idea behind compound interest is quite simple. Money makes money, and that money makes money. Okay, so yes, I do think, excuse me, in general, the sooner you start investing, the more money you can make, because again, you can never get back time. But I also like people to think about saving, right? I don't know how I can say this more. I can't emphasize it enough, is that it is so much more important to start saving. Now there's a period where you can be saving while you're investing, because quite frankly, you should never stop saving. And there will be a point, when it makes sense to start investing. And I could feel comfortable saying that you probably won't want to ever stop investing either. You will certainly change how you invest over time, because of risk and time and that kind of thing. But you really want to make sure that you have some solid savings in place first. And I would say at minimum 3 months worth of living expenses, but you want to get to the point where you have at least a year's worth of living expenses saved. I would say once you have at least 3 months of savings put away, 3 months of living expenses. So like your mortgage, your car note, your insurance, if your, kids have, daycare or something like that. You want to know that you have at least 3 months worth of that put away before you start investing. Again, this is a general statement, but you really want to make sure you have that money in place. And when I say saving, I mean that it's risk-free money. You don't have to worry about the principal being lost, and you can get to it easily and quickly without like a penalty. So many people are taught, like, as soon as they get a job, just start putting money into your 401k, but you have no liquid savings outside of the 401k. Maybe you still have, a lot of credit card debt and stuff like that. It doesn't make sense for you to be locking up money into a vehicle like a 401k plan, where if you need to get to that money, you're going to have to pay a penalty to get to it, plus pay the taxes, when you already have other obligations, right? So my point is that everyone's situation is different, and you really should speak to a financial professional so they can understand your whole picture. And then you come up with a strategy as to, how you're going to start building up your savings and how and when you start investing. But you want to be mindful of just kind of hopping onto social media and seeing like fun, slick videos. And just because someone has a whiteboard and a dry erase marker, it does not mean that they're an expert. And it certainly doesn't mean that what they're showing you or explaining to you works for you specifically, right? There are some things that might work for one group of people and others that might not work for you. So I can't express, enough that it's really important to, consult with a financial professional. And even if, some people aren't comfortable, always going to one, but if you were to just spend a few $100s for a consultation with one who could just review what you've done, that I think would also, go a long way. So in all, I would just say in summary, let's be mindful that, social media is fun. It is a great way to share information. And I'm sure that there is some good information from financial professionals on TikTok and, other social media platforms. But please always use due diligence, use common sense. And if it sounds too good to be true, go speak with a financial professional. If it sounds like it might be illegal, go speak with a financial professional or a CPA or an attorney. Like, find out before you start taking steps, before you start reaching out. Just do a little bit more digging, and make sure that what you're seeing and what you're reading actually makes sense and actually will help you reach the goals that you want to reach. A lot of information that's out there really benefits Wall Street and the companies that are marketing the ideas and the concepts. But if you're working with, a reputable financial professional, someone like me, then you can hopefully get the right information that makes sense for you, your family, or your business, and then you can take steps from that way. All right. Thank you for joining me for another episode of Rebel Rock Money Talk podcast, and we will talk soon. Bye.